I like to say QE infinity is inevitable. But with resumed QE, what you have is accelerated fiat debasement. Now, everyone needs to understand that the US 10-year note basically sets rates for the rest of the world. So what happens in the USA impacts the rest of the world. And it's those other secondary and tertiary fiats that get really, really hurt. So we can look at Bitcoin price in US dollars, but sometimes I encourage you, I'm a Canadian, a G7 country. Canada is a G7 country with an economy that's smaller than the state of California's economy. You guys are very lucky to live in the United States. It's a beautiful, integrated economy, but it sets rates for the rest of the world. And sometimes when the USA catches a cold, everyone else gets very, very sick. So we have to understand the context on a global macro basis. Over to you, James.
Yeah, so something that's really important to understand is we keep talking about QE and how the Fed's going to pivot, they're going to provide liquidity to the market. This is all, the reason why they must do that is exactly what we're talking about. The Treasury must have a market that will buy Treasuries. It must stay liquid. It absolutely has to have a place to dump all these Treasuries. And you're seeing the rates of the Treasuries rise on the long end, looking for price discovery on where these rates are going to go, because they know that the Fed, or the Treasury has to have a market for them. It cannot break. So when we talk about QE, quantitative easing, what we're talking about in simple terms is the Treasury pushing a button, putting a bunch of money on the Fed's balance sheet. The Fed tells Citigroup and JP Morgan to go buy a bunch of bonds in the market. We're going to buy them back from you today. The Fed gives them the money and then turns around and holds the Treasuries on its balance sheet, right? So that's QE. They're literally monetizing the debt. And we've seen this happen in Japan, where Japan owns, the Bank of Japan is the largest owner of its own debt. Think through that for a second. They own more than 50% of its own debt. So that's where we're headed as a country. And so, but that's when we talk about QE, we talk about having the Treasury come in to save the market with the Fed, because it must have that market.
And as Greg says, it's just math. And historically, we've seen this many, many times. We saw it in 2008. We saw it in the repo crisis in 2018. We saw it in March of this year. I mean, the Fed actually arguably already has pivoted. BTFP was a small pivot. And so we know that their third mandate, their two mandates are obviously full employment and inflation. They failed at inflation, obviously. We know their third mandate is keeping the system functioning, and every time it doesn't function, they do the exact same thing, which is they pivot. And I want to just read 3 headlines. These are just from yesterday. Nick Tamaros in the Journal: if the bond market keeps this up, the Federal Reserve will have less of a reason to hike rates again. Wonder what that means. Wall Street Journal headline yesterday: rising interest rates mean deficits finally matter. Bond sell-off might force the Fed to rethink shedding assets. What does that mean? Okay. Breaking markets, Fed's daily. With the rise in bond yields, the need to do additional tightening by the Fed is not there. What does that mean? These fuckers are going to print. They're going to print until their fucking eyes bleed. And we know it's going to happen. And so all we've got to do is outlast them and then watch them as they suffer. You know, they were very close to losing control of the whole thing in March when Silicon Valley Bank went down. I mean, they thanked their lucky stars that the BTFP worked and that, Aunt Janet was able to bluff everybody into believing that they would cover all the deposits, because there's $17 trillion in bank deposits. The FDIC cannot cover that amount. But those banks are still hurting. I mean, 50 to 60% of the banks probably have negative equity right now. And wait until the wages from all these labor movements start to flow through the earnings statements of all these companies. I mean, I feel terrible for these people who are striking. I understand why they're striking. The strike is they're getting roasted by inflation, but they're about to lose. They're about to realize they got a bigger problem than inflation. They're about to lose their job because the companies are going to fail, and then they're going to be out of work. I mean, Guys, I mean, sadly, this is going to be an unbelievable shit show, in my view, in the next 12 months. And my sense is that politicians are going to respond the way they've always responded, which is to cover their own ass, to try and protect their own ass. And the lowest hanging fruit, the easiest way for them to do it is going to be to chop rates and send out UBI. And to answer your question, Preston, I think it's going to be unbelievable. I think the Fed balance sheet is going to 20 billion or 20 trillion on the next cycle. They're going to have to, because once again, you know, they're steering this car between these guardrails of too much inflation and too much deflation. I mean, we've got negative M2 growth today. We haven't seen that since 1930, which was the Great Depression. And so if they think they can do the same thing and not have the same result, good luck. It's going to be a mess.
So I guess I would say, I think in the coming 12 months, we're going to be, as Bitcoiners, going to be kind of surprised at some of the things that we see. In particular, I think one of the things that's going to surprise us most is I think you're going to actually see a large bank, call it Fidelity, BlackRock, or whatever. I think they're going to actually, I think the ETF's going to get approved. I think you're going to see one of these large banks actually start to recommend Bitcoin as a percent of the standard portfolio for people. And I know that sounds crazy for people listening to that. I think that's happening in the coming 12 months, where I could see a BlackRock say, we think it's appropriate for 1% of a person's portfolio to be in Bitcoin.
Oh, and by the way, we have this ETF for you.
And we have this ETF vehicle for you to do it, which I don't think anybody should invest in. I think they should self-custody, buy their own Bitcoin, hold their own keys. But I think that it's their only hope out of this. I think there's people on Wall Street that are actually able to do this math. I think they're somewhat starting to see what the value prop of Bitcoin is, in that it actually provides salvation to this disastrous scenario. And I'm very hopeful that that it'll be hopefully enough to kind of bridge this transition. And I think hang on to your hats, because I think the next 12 months for Bitcoiners is going to be one hell of a ride.